Welcome to Yahoo Finance This Morning Brief. I'm Julie Hyman. Joining us today, Yahoo Finance's Jay Conley and Ryan Payne, who has the proper chair height right now. He's
took a while, but we got there.
Host of the Pain Points of Wealth podcast. What kind of chairs do you have in your podcast?
We have a lot of different type of guests. We have a lot of...
chairs.
Chairs. No.
What are we sitting in?
We have like lounge chairs. We have like couch, and it's a pretty hip setup.
Big leather chairs,
big leopard skin rug with a disco ball. No, it's not like that. But it's we have very.
We're not quite hip enough here, Julie.
No, we are definitely not. We're
a little too buttoned up.
I could work on the decor for you. Yeah.
Thank you. We'll bring you in as a consultant.
Wherever you get your custom orders from, we'll take input.
Exactly. Well, the little pillow on the chair does do wonders, I have to say. So let's talk about the markets this morning as we are heading further into earnings season. We're actually seeing the chips coming back again. That's sort of the thing that stands out to me the most this morning is that we had like a sort of half chip rally yesterday, and now it seems to be more full-throated today. Like when I was looking at the pre-market, chips are up, AI's up, Intel is up ahead of its earnings later this week.
Yeah, I mean, look, if you look at this year so far, we just had these chips have this magnificent run up, right? Yeah. Halfway through the year, we're like 100% on the iShares Semiconductor Index, which is like, that's halfway through the year. You look at stocks like Micron up like 600% over the last 12 months. They were due for a pullback. So you saw close to a 20% pullback. Everyone's saying, wow, it's like a real market correction. Like, not really when you're up over 600% over the last 12 months.
You really can't call that a bear market when you're up that heavily.
Yeah. You're just a little less rich than they were yesterday. So I think, bottom line is you had some profit taking halfway through the year. Now maybe you're seeing a little bit of a re-rotation back into those stocks. But if I look at a chart on those stocks, looks like a correction in a very big booming bull market. And what's crazy about it is even with stocks like Micron, SK Hynix, up triple digit returns, the earnings picture is like outpacing what the stocks have gone up. I mean, if I look at Micron, it trades at like 6 times forward earnings, which for those at home, that's really cheap. So the question becomes, though, when do these earnings expectations just get way too high for these companies?
Or when do they start to run out of steam, right? It's so interesting to me. That was the conversation around NVIDIA for so long. Like, oh my God, look at this earnings growth. How long can it last? And then it just kept lasting and lasting and lasting. And so I think that now becomes the question around the memory chips also.
Well, and I think you're talking about a segment of the market that's highly cyclical. If you think about SK Hynix and Micron, made no money 3 years ago. They lost money.
Yeah.
So I think, the business cycle hasn't been repealed. And I think the problem is these analysts, they were late to the party predicting this whole AI boom, right? They've been just catching up with their estimates. They're going to be way too rosy, too long on how long those estimates are going to grow. So when that hiccup finally comes, I think it's going to catch Wall Street off guard. Like, you're not going to be able to predict it ahead of time is the problem.
Yeah. So we're talking about the seller side of the market. SK Hynix, NVIDIA, Taiwan Semi raising prices this morning, saying they're going to raise prices this morning. You also have the buyer side of the market in the Mag 7, some of the hyperscalers. We're going to start getting those earnings tomorrow with Alphabet. What are you looking at going into those reports to check in on how all this is going to shake out?
Yeah, well, I think first off, earnings expectations are extremely high, right? For the tech sector, year over year, over 60% growth. Like, that's really high growth. The average is 12% a year for the market long term on earnings growth. So I think, what you're going to wonder about here is, are they going to disappoint? Now, if you look at the Magnificent Seven, those stocks really haven't gone anywhere this year, right? If you look at them as a collective, you're like flat for the year. So I kind of feel like probably earnings expectations will probably surprise to the positive, not the negative, because there has been a kind of a sell-off in most of these stocks, so far this year. So I think it's all going to be about, are the expectations going to be met? And my guess is they probably are.
But then the next question is, will the stocks go up? And I don't think that is a given, even if they beat estimates, because that's what we've seen in the past. I want to point out something that, the fundamentals mostly remain rosy, I think, even if the stock action does not.
Yes.
There's one thing, though, that maybe is a little canary in the coal mine again, and that's Oracle. If you look at Oracle, those shares, they haven't just gone sideways. They've continued to go down. Yeah, they're trading up this morning, but their credit default swaps are at a multi-year high now. I think it's 18-year high for those credit default swaps, and the stock has just continued to go lower and lower and lower. So there is there does seem to be still these concerns under the surface about financing all of this, about whether everyone is going to get a piece of the pie, and about the sort of financial health of the other players. And I wonder if this extends to like some of the other neo clouds at this point, because those stocks have mostly been not trading like an Oracle, which is interesting.
And to your point on financing, Oracle was also one of the first companies to come out and start issuing an absolute load of debt, which kind of kicked off all these concerns of, at one point, these were free cash flow giant companies. Now, if you're having to finance everything with debt or with share sales or whatever else, what does that do to the long-term prospects for your business?
Yeah, 100%, and that's the big question, right? That's the big question is like, where's the return on investment? I mean, it was like $250 billion worth of debt. Even NVIDIA has raised money here to keep fueling this. And I think the other problem is, now, I know we're going to talk about some of these Chinese AI models as well, and they're a lot cheaper. You're going to have more competition, especially when it comes to large language models. And then, it comes down to like, well, do I need the Ferrari of semiconductors, or can I get away with a Taurus?
Right.
So I think,
Great comparison.
Yeah, there you go. I mean, at some point, you probably don't need the most powerful model. Like, I'm guilty of this. I use Microsoft's Copilot, which is considered like the worst model. It does the job, though. It does what I need it to do.
It's fine.
Yeah, it's fine. So I think, to your point, maybe, I don't think we're at the top yet. I think there should be a big rotation back into these stocks. I think there's just too much money out there. The estimates are too high. But I think at some point here, all these questions we're talking about today are going to come to a head, and maybe invariably that's what's going to like stop this huge, massive run up in these AI stocks that we've seen.
So we rejiggered things a little bit. So we're going to not talk about Chinese AI separately, but let's talk about it for a minute here, because I think it does feed into all of this, right? And the idea that you've got the closed large language models in the U.S. sort of now nudging the U.S. to regulate the Chinese models. And then you have those even within the tech community who are pushing back against that idea that you don't want to regulate. Yesterday, I talked to somebody from CFR who said, that it's more nuanced than that. It's not just like ban the models or don't ban the models.
Right.
You have to sort of come in and look at it on a case-by-case basis and see what the source of the model is and do it in a smart way. But I'm not convinced it's going to be done.
And for a buyer who doesn't need the Ferrari and who doesn't need to be spending all that money, the option for a cheaper open source model is not going to be a bad thing. And maybe that's attractive from business case. We see the Wall Street Journal actually last night, some really good reporting, OpenAI, Anthropic leaders all kind of saying, look, these models are sketchy, we need to regulate this, the company shouldn't be using them. How much of that is a security concern? How much of that is we don't want to lose our business?
Right.
Impossible to know, but it does raise questions of if you don't need the Ferrari, you see the appeal.
Yeah, you see that. And the other problem is, as some have raised, if you regulate the Taurus, and you force everyone to buy the Ferrari, you're not doing the business model any favors, because there are people who are not going to pay it.
Yeah.
Right.
Right.
And then you're just going to, sort of cause cracks in the system.
Yeah, I'm glad my analogy just like keeps running through here. This conversation is great.
It's good.
No, but I think that's totally true. And we'll talk about car companies too. Like when we kind of closed off the Chinese market for electric vehicles, besides Tesla, we don't have a really great car market here. I mean, you go around the world and you see the kind of Chinese cars that are out there. I mean, they're just so far ahead, especially when you're talking about electric vehicles. So I think by becoming a more closed economy, so to speak, when it comes to AI, could be very, very dangerous down the line, and it can make us less competitive, to your point. So I think, for all those reasons, it's fraught with a lot of risk, closing out some of the competitors that we're going to see overseas, for sure.
All right, let's talk about one car maker in particular, General Motors. The company raising its forecast, thank you, by $500 million. Saw lower tariffs, which was good for the company, and better margins on its largest vehicles. So that helping things here, even though, as you point out, it's not like the car market here is good. It's just, it seems like the best we can hope for is sort of not as bad as expected. I mean, and they're making money.
Right. They beat on top and bottom line, but they came out and announced they're still on a loss on their EVs. That is still not the market they probably wanted it to be. They're selling they're making more money, but they're selling less cars, just trying to drive higher margins. But at some point you have to ask, we saw the EV market pull back. Can there be a return to form? Can Tesla come back? Can this market really start opening up again? Or are we now ceding that back and kind of forgetting that, and at least for the next few years?
I mean, at some point, I think there's going to be a more large-scale migration to EVs and AVs.
Yeah.
But like in this uncomfortable transition middle period, it feels like the traditional car market is going to be challenged for a while. I mean, everybody's driving their cars longer.
That's right.
No, it's a good point, and also, but you also have to factor in oil prices are higher too, right? So how long do we stay with higher oil prices? I think that's got to be a big catalyst. And maybe not just here, but especially in Europe, where of course they're energy dependent. I can see that push towards electric vehicles, being a much faster migration. But also, like, besides Tesla, we don't have great EVs here.
Right.
And overall, it's not a great market. Like, there's no EV I really think is like, well, that's amazing that America makes. And I think that's another problem. So maybe if you get some more competition and you get some better cars out there that you actually want to drive, I think that would also be a big catalyst towards EVs.
Yeah, maybe so. I mean, and the other thing is that again, they got the tariff boost. But who knows how long that's going to last? We got these, now new tariffs on Canada that don't affect autos specifically, but it's just sort of a reminder that don't get too comfortable because you could have some new tariffs coming, and so that companies can sort of benefit from this tariff reprieve while they can.
That's right.
We don't know if it's going to last.
Also of interest, at the World Cup final, President Trump, Prime Minister Mark Carney, and Commerce Secretary Howard Lutnick all in the box together.
Oh.
Were they talking soccer or were they talking tariffs? That's my question. How much of that got ironed out while Spain beat Argentina?
Well, obviously nothing got ironed out because now we have this new tariff.
That's right.
So they didn't. Maybe Carney was talking trash.
Yeah, that's
up
right.
there in the
No, that's
box.
right.
Who knows? I mean,
He
I
pushed
don't know.
Lutnick a little too far.
Maybe he did.
Lutnick was an Argentina fan.
I want to make sure we save time for the last thing because we are very passionate, Jake and I, about the Miami stories. But let's talk about drug makers for just a second. Novo Nordisk is filing a suit against Eli Lilly today, and it has to do with allegations of misleading advertising, which is interesting here. Basically, what Novo is saying is that Eli Lilly ran ads saying that its products were more effective than that of Novo Nordisk. Novo says you weren't comparing apples to apples. You were comparing a lower dose of Novo's stuff to a higher dose of Lilly stuff, and if you look at newer research, it doesn't hold up. I have reached out to Eli Lilly for comment, and we have not yet. I'm just checking my inbox again. We have not yet heard back from them as of yet. But who knows how this particular lawsuit will end? But it just illustrates that there is a lot at stake.
Right, and
when it comes to
the obesity market expected to reach $120 billion a year by 2030. So this is not a small market that's going away. Yeah. And there are really only two players. Eli Lilly, for now, Eli Lilly and Novo Nordisk. Now, maybe does a smaller company come in and manage to produce something cheaper, have better drug efficacy, but for now...
there are also big other companies that are working on
That's right, they're working to get there.
They haven't gotten there yet. I mean, and it's interesting that we get this lawsuit when Novo's new pill has been performing very well against the newer entrant from Lilly. The stocks have done very differently. Novo Nordisk is down about 20% over the past year. Lilly is up 50%, which has been interesting.
Well, I think that's also part of it, right? Because I think that market is getting saturated. So it seems to me like there's a little bit of desperation when you're going after the advertising because one drug's slightly more effective than the other drug. So I think right now you're at a point where you kind of have a saturation in the market. That's one of the reasons. I mean, Novo got priced to the moon just based on what you're talking about. Just demand is going to go up exponentially over the next couple of years. So I think you got that saturation point. So when you start getting petty about your litigation, that says to me, growth is a problem, right? You're not looking for other ways to grow. You're looking to, I don't know, sue your way out of it.
You're a little too focused on the competition and not on your own results.
Yeah.
If you look at the numbers, though, especially the pill numbers, Novo has been holding up well.
That's right.
So, I mean, I forget when the company reports, but I guess we'll find out when they report exactly, how they're holding up against Lilly.
This is also coming.
Quick. Early August is when we hear from Novo Nordisk.
Yeah, Eli Lilly also working on their retatrutide new medicine that's supposed to come to the market at some point.
Yes.
That has become immensely popular in the gray market for being allegedly, there are no test results really yet, but allegedly more effective than Ozempic or some of the other options. So that could be a huge boon for Lilly if the results are really, really good. But of course, we don't know that. We don't know if they're going to get FDA approval. There are a lot of steps to get there.
Well, and speaking of the gray market, as you and I were talking about before the show, that actually also presents one of the biggest competition points to these two companies for people who are willing to play a little fast and loose.
Right.
People are getting this stuff from China and getting it on the gray market. Some of these, not just that drug, versions of the existing.
And there are U.S. doctors who will prescribe gray market drugs.
Yes.
So you don't have to go to some illicit website or something. You can go to your primary care and get some of these prescribed.
At a discount to what the list prices are.
Well, hence, that's just more competition in the market. And I think it's, again, you had two players. Now, all of a sudden, you have a lot of other options where you can get the, as President Trump likes to say, the fat shot. But, or now a pill, apparently. Yeah. So I think, from that perspective, it's just like the market's becoming way more saturated. And I think we've already gotten to a point where Wall Street has priced in a lot of the good news on growth. So.
See, I don't think it's saturated.
Really?
So many more people are going to be taking this stuff.
I
think there's a lot. I still feel like there's a lot. I mean, like, what percentage of the population is taking this? It's not big. I don't know off the top of my head.
I know.
But it can't be.
But it's got to be concentrated in a developed market like the U.S., right? It's not like.
Right. But even in the U.S., there's probably a lot more room. Probably there are people who are priced out where it's not being covered. And so if you see coverage changes, you'll probably see an uptick in people who are taking it. Because right now it's people who can afford it.
Right. So
it scares me.
Per Gallup, in 2026, this is just GLP-1s.
Okay.
But per Gallup, 2026, 11% of U.S. adults are taking GLP-1s.
Wow.
Which is a higher percentage than I would have thought it would be.
And what's the obesity rate in the U.S.?
That's a good question.
Right? So among
U.S.
adults.
obesity rate from the CDC, 40.3%, with nearly 10%
40.3%.
10% classified as severely obese.
Yeah.
So there's like kind of a 1-for-1 of severely obese percentage.
Yes, except it's not the severely obese
no,
people
but it's
who are
not.
taking
That's
the GLP-1s.
right. That's right.
Yes.
There's a lot of people who are fat shot by choice.
Fat shot by choice.
Who don't necessarily eat for health reasons, or even who are obese in some cases. Anyway, the point is, I personally think there's a lot more potential in terms of scripts on these various drugs, and that's why I think it's not so much that the market's getting saturated. I think it's rather that there is so much more upside that's why there is so much fighting between these.
And more competition, right? If you're going to have more alternatives where you get the price down, I think that's going to be another problem here. It's going to become a more competitive market. So,
and this is
God knows when the
go.
health effects come out about this stuff years later. But
the cohort study in 20 years is going to be magnificent to see.
Very interesting.
It's like cigarettes back in the day. Anyway.
Right.
All right. Speaking of competition, cutthroat competition.
Yes.
Miami, New York, one of the great rivalries of the last decade. And I say that because, I don't know about you guys, but just anecdotally, I know quite a few people who have moved to Miami.
As do I.
And then and then you got the people who have people who are out, normal people out in the world probably don't know this, but very wealthy people, if they are spending time at their homes in various states, they have to track their whereabouts on an app to make sure that they are paying taxes in the proper place.
So you have X days, you've got to pay taxes.
Which I think is amazing.
Right.
Bloomberg,
New York wants their tax money.
Bloomberg is out with a story saying the cost of living in Miami has surpassed that of New York. So ha to all those people.
You can't make the it's cheaper argument. Can't do it anymore.
You can no longer make the it's cheaper. Now, if you're super rich, if you're the Ken Griffins of the world.
You're Kenny G.
I mean, you got enough, maybe on that, they're not price sensitive, and it's also ideological. They want to be in a state that doesn't charge income tax. But when you add up all the other stuff, when you add up the private school, when you add up real estate, which has gone up a lot in Florida, when you add up insurance, which is the highest in the country, and I gloat a little bit, because I think New York is amazing, and I'm not a huge fan of living in Miami. Sorry to the people I know who live in Miami. So I think this is sort of fascinating that this is happening. I don't know.
I still don't believe, I don't know why. I know the numbers, I read the article. It just still seems to me like New York is so outrageously expensive.
Have you spent a lot of time in Miami?
I have. I guess it depends where you are in Miami too, right?
Sure.
It's very, very clear. If you're in the hottest parts of Miami, you're right? It is mind blowing how expensive it's become.
Sure.
But when you still look at per square foot, what is it, $300 the median's like $329 a square foot versus New York's $580 a square foot. So I think.
But if you want to live in Coral Gables or like some of the other hot areas, it's the homes are crazy in those areas.
If you want the waterfront mansion, you're going to pay your $50 million for it, of course.
Yeah, of course.
Yeah, which I've been contemplating.
Yeah.
But
But I think even if, and property taxes, according to that article, are up 62% since 2019.
Yeah.
So, it's, and there's also, the culture is such in Miami that there's also this culture of like one-upsmanship.
Right.
yes.
Too.
So, okay, Julie, tell your
Which I
joke.
don't think really happens in New York.
You can hide better in New York if you want to. You can be
Yes.
very
That's
wealthy
true.
under the radar
And be
screen
very
in New York.
discreet.
Yes,
Yeah, I think that is actually a great point because there is more of that. What do they call it? Lifestyle creep? If I'm using
Right.
it right.
Yes,
yeah.
yes,
right.
yes.
Right, where you're keeping up the Joneses per se, probably
Yes.
more. In New York, you can kind of you can fly under the radar screen if you want to.
So
right?
the
Yeah,
joke that Jake
Tell the
is
joke,
referring
please.
to
Tell the
that I
joke.
told before the show that
Yeah.
a friend of mine told me because my most recent trip to Florida, I went to Miami and I also went to Naples. And my friend said to me something like, what's the difference between a Lamborghini that you see in Miami and one that you see in Naples?
My parents live in Naples. This should be good. Okay, so what is it?
The one in Miami is rented.
It's totally true.
And there,
it's totally
in
true.
Naples,
It is.
You don't
Yeah.
have that sort of like over-the-top shows
You don't need to
of
flaunt
wealth
it.
in the same
Yeah.
way necessarily.
That's right.
What seems to me is if you look at, because my parents do live there, is it's a lot of people from the Midwest. And a lot of these people had like manufacturing businesses. Like we do manufacturing in the US, you forget. And you're totally right. It's definitely a much more, they're always like friendlier, which as a New Yorker, you're always like suspect, why are these people being nice to me?
Right.
But in a way, I do love that glitz about Miami. Like you'll see that gold Lamborghini driving down the street and you know it's probably rented or someone's like living in their parents' basement, but they've got the rented Lamborghini.
It's fun
And there's
to
just something
visit.
about that. You're like, this is a great place. I don't know why I love
It's
it.
fun
Right.
to visit.
Right.
It's fun to visit.
Right.
I personally would not want to live there, and it's no accident, by the way,
Yeah.
that it's become like the crypto capital of the
That's
U.S.
right.
as well.
That's
Yes,
right.
exactly.
There's, the
Glitzy,
Venn
fake
diagrams.
things.
Yeah, that's right. This has
true.
also come up, even
Yeah.
more hotly ever since Mayor Mamdani here in New York brought up the pied-à-terre tax.
Yeah.
Some other
So
things
that might
aimed at the
change
wealth
the
tax.
equation again for,
Right.
in terms of
And
cost
shift
of
it
living
back.
for.
Yeah.
But there's
especially
always
don't
the
think it
question
will,
of out of
yeah.
the people who say, I'm leaving New York, I'm going to Miami, I'm never coming back, what's the follow through? And I've never seen that number.
You know why? It's because
Yeah.
like it's death by a thousand cuts. You just get taxed enough that you don't leave, which I don't like clearly understand because I'm still here in New York. I've been here for 20 years plus, and let's face it, it's getting dirtier. The prices, I don't care if you're.
it getting
Oh my
dirtier?
God, come on.
I don't know.
I don't know where I live. I live down in Tribeca, and it's not pretty. It's not clean. But we're paying, but the prices we're paying, whether you're lower income or higher income, it doesn't matter in New York. It's the prices continue to go higher and higher. And I can't figure, here's my theory on this. I just think, even with all the additional taxes, I think the wealth effect is so real. It's like 60% of Americans now own stocks. If you're wealthy, you became way wealthier since the pandemic just because you look at the stock market. Your real estate values have dramatically outpaced inflation. I just think people, doesn't matter what price you put on it, because of their value of their net worth has gone up so much. That's why if you look at like World Cup tickets at like $8,000 a ticket for like the cheap seats, I think that's part of the dynamic right now. Until you see some real like market sell-off, economic slowdown, I think these politicians can keep taxing you even here in New York. That's my theory.
That's probably right. And by the way, maybe because I lived on the Lower East Side when I lived in the city, it started dirty and it stayed dirty.
Nothing.
And there's something
Yeah.
beautiful about
and that's
that.
a feature, not a bug. But,
That is a good thing. We like our dirt in New York.
But not in Tribeca. I get
I'm right
it.
by
Not in
Canal Street where it's
Tribeca.
just like, if you want a fake bag, I can get you one. It's like, it's wild.
I'm good on
over
the
there.
fake bag. That's been there for a long time.
I think it's
Yes.
getting wilder, by the way.
Back from the 80s.
All right, thanks guys. Ryan, Jake, we'll debate where to live more off camera.
Yeah, thanks,
Opening
Julie.
bids next.
And you thought we were going to get through a summer without renewed tariff concerns bubbling back up to the surface? Think again, my friends. President Trump just slapped an additional 50% tariff on a sweeping list of Canadian goods, from wine to hockey sticks to cement. He did it on the eve of a major USMCA trade negotiation scheduled for today in Mexico, where top U.S. officials were supposed to be sitting down with their Canadian and Mexican counterparts to work things out like adults. This is not a small escalation by the president. Canada is America's second biggest trading partner, a next-door neighbor with whom the U.S. does over $900 billion in annual trade. I asked GM CFO Paul Jacobson for his thoughts on this in the wake of the company's better-than-expected earnings report this morning. GM has vast operations in Canada, and while these new Trump tariffs don't apply to autos, it's a headwind to growth that GM and other manufacturers just don't need.
We're optimistic and hopeful that all the sides can come together across Mexico and Canada to make sure that trading bloc remains strong to be able to compete around the world. Well, we never passed through any tariff-related price increases. We said we were just going to be consistent with the way we've gone to market, and we've done that, and I think that's important.
Even with no price increases, I think that truck just behind Paul is a little out of my price league. Now, if there's any positive here, it's that markets are taking the news in stride. We are also seeing a bid return to momentum stocks like Micron back in focus. Here in the opening bid roundtable, Adam Coons, Winthrop Capital Chief Investment Officer, alongside Yahoo Finance Brooke DePalma and Nesfere. Good to see you all. Adam, let me start with you here. Good read on the consumer coming off this GM report.
Yeah, absolutely. I think kind of reiterates and reinforces the narrative that the U.S. consumer has continued to surprise to the upside with their resilience. So just another kind of piece of the tape here that's adding to that story.
Adam, why do you think the market's shaking off these tariff concerns?
Well, I mean, it's the same old story, right? It's come in with a heavy hand, a big number like 50% as a negotiating tactic. So I think the market's kind of figured out the tactic out of Washington, and so largely is just going to kind of brush this off as, like I said, a negotiating tool.
And as Liberation Day, it's still burned into all of our brains, but a good thing we're just not seeing that market reaction.
Yeah, that's right. And as Adam,
go ahead, Inez.
Yeah, as Adam was saying, it's basically coming in with a heavy hand at first, and then, oh no, we're now going to negotiate much better, and then you see the markets going higher. But as you mentioned, Saz, I think that part of this has to do also with the momentum stocks really getting a bid. We saw that yesterday, although it faded by the end of the day, but you still saw semiconductors up as the complex as a whole yesterday, and also today you're seeing semiconductors again, because you still have that memory supply crunch, and that is expected to go on into 2027, 2028. So Street still positive on that semi trade, even though we've seen volatility recently.
And as it's a good call out, I just posted a story on General Motors to our site. Buried in that GM report, and as is GM talking about higher component costs for DRAM. That's a good tie-through. If you were concerned about the fundamentals of Micron and SanDisk and AI demand slowing down, this GM report told you something completely different. And I think it really was a reminder that the fundamentals of these companies remain very strong, not just for the balance this year, probably for the next few years, Inez.
Yeah, they're saying 2027, 2028, you are still seeing the pricing power that these companies have. You see the pricing when it comes to TSMC also talked about tools getting more expensive. There's this sort of AI inflation theme that is happening, and it's because you're seeing these high prices for these components for this hardware. The question will be if hyperscalers at some point start to slow down some of their spending, what will happen to those stocks? Perhaps will they be rewarded for slowing down some of that spending? But then what will happen to stocks like SanDisk, stocks like Micron, which are the beneficiaries of all that spending?
Brooke, it's not cheap to buy a lot of things that General Motors is in fact selling, and it goes beyond the Corvette. I mean, the average selling price, I think, for their pickup trucks are now $52,000. They got a new bunch of new models coming out in the fourth quarter of this year. All in all, a good read on the U.S. consumer. And I would say we even got a taste of that, no pun intended, from Domino's when they reported yesterday.
Absolutely, Brian. It seems like based upon all these reports, the consumer is holding up. And like you pointed out, those trucks are not cheap. I mean, mom's certainly in the market for a car or a truck. I mean, I don't know about that, but a midsize SUV would be nice. And those prices are absolutely astonishing. And when you think about the truck sales, even the CFO telling Yahoo Finance that truck sales are up about 4% year to date so far. And so this leans into the fact that the consumer is focusing in on what they really want to buy right now, and they're willing to splurge on those items despite all this macro uncertainty going on. Keep in mind, this quarter up to, a mid of June was in fact during the time where we did see gas prices rise to about $4.56 during that Memorial Day weekend. And now we're seeing gas prices surge about $4 yet again. And this is the first time ever, Brian, that we did see gas prices cross $4 twice in 1 year in history. Despite that, though, like you said, Domino's holding up just a little bit. They did see their slowest U.S. same-store sales growth in about 5 quarters. Sales here in the U.S. were up about 0.1%. And so all things considered, though, the consumer continues to go on and spend, though, Brian.
Brooke, just get something used off Carvana. I've bought several cars from there, Brooke. They're really good. It's very easy and a lot cheaper.
All right, I'll have to try it. Brian. Never tried it, never thought about trying it. So look at that. I learned
We just bring great ideas here to the opening bid. I know you're also watching SpaceX. We got that earnings release set for early August. Big day for SpaceX.
Yes. So SpaceX, I've been watching SpaceX and the earnings release on August 4th, quarterly results that are expected then. But what will be interesting to see is what happens to the stock a couple of days afterwards, because you have the lockup period, which is expiring for 8% that unlocks on August 8th, August 6th. And then thereafter, you have bouts of spurts there where you will see unlocking periods through December 9th. By December 9th, you're going to have 40% unlocked. And then the other 60% will be summer of 2027, which includes Elon Musk's shares. So really what the street's watching, or what investors should be watching, is really that unlock period and what happens after that. And also, of course, what is going to be said on that earnings call, because I think that'll be fascinating.
No, it will be fascinating. I think we got a taste of that a little bit this week with Tesla. And then, Brooke, let me get back to you on SpaceX, because what I'm trying to figure out is if the stock has been selling off in advance of these lockups expiring. When you see this happening historically for IPOs, you see a wave of shares come to market and it pressures the stock price.
Yeah, I actually want to look at some Alpha Space data here, because I do want to see where SpaceX is holding up right now. As we make our way to past the open, it's sitting about $122 based upon what I'm seeing right now. Of course, that's well below the IPO price that this company debuted at. And at the same exact time, I mean, it's going to be a matter of time before Elon Musk, and as mentioning a little bit, but what we're seeing out this morning is that Elon Musk's, his remaining 60% shares, that includes Elon, are now eligible for release until a full year and a day after that IPO on June 14, 2027 is when that will become eligible for release. And so it'll be interesting to see the run up that this stock has had, the momentum that this stock has had, and now a pullback as investors sort of assess, okay, what is this? Is this worth that long-term momentum that so many on the street are so bullish about? But just how long-term are you willing to play within this stock as well?
Adam, staying on the tech trade, we'll get Alphabet's results this week. How important of a market mover do you think that report will be?
Oh, it's big. I mean, obviously, it's one of the biggest stocks in the market. So just that in itself is going to be important for kind of the market sentiment. But, I think the market does continue to feel very healthy. Going back to SpaceX, I would argue that the sell-off after the hype and euphoria kind of shows that the market is really digesting and sifting through what they believe are the winners and losers. And, Google has stalled out a little bit, but it's definitely one of our favorite stocks. And so I think, despite whatever this next earnings release brings, it'll be important for the overall kind of barometer of the AI story, in particular because Google is one of the most vertically integrated as far as, not only their AI models, but they produce a lot of their own chips as well. So, I think it will be a good indicator of what to expect in the rest of the earnings season for tech.
What type of barometer, Adam, is an Oracle? Oracle shares coming into today officially down more than 50% from June 2nd. What does that tell you about the AI trade and the outlook?
Well, this is an idiosyncratic story from my point of view. When Oracle ran up to its highs, it was really based off of the same thing I just hit on: a lot of euphoria and a lot of promises that I saw as hard to fulfill. In particular, I think the velocity and volatility around the stock comes because they do have so much debt. Probably not enough people talk about that, but unlike Google or Alphabet, who is debt light, Oracle, they're a low BBB rated debt issuer and have quite a bit of debt, so they just don't have as many levers to pull either. It's not a good story from my point of view.
And as Adam brings up a good point in the market, picking winners and losers in AI, one potential winner, and it has been a loser, that's Meta. Meta shares up about 12% in the past month.
Yeah, and Meta has a way of, when you see that stock going down, and we've seen it over the years after earnings reports, you will see that they eventually go higher. And Meta has advertising. It is dominant in the social media space. It is heavily involved, of course, in AI and data centers, perhaps renting out some of that compute as well. So the Meta story is far from over, despite the sort of drawdowns that you've seen in the stock. So yes, up 12% year to date. Another one that has been has done very well out of the Mag 7 is also is Apple, by the way. And to Adam's point, Google or Alphabet is going to be such a teller in this earnings season because it's so integrated. I mean, there's the information report that they are developing a new server chip. So they've got their chips, their TPUs, now this new server chip that is supposed to come out next year. They've got their AI model, and then they have the whole consumer-facing side as well, advertising, YouTube. So it is a behemoth when it comes to the AI trade. And of course, it's a hyperscaler, a big spender of CapEx. So all around, it'll be interesting to hear what they report.
Points well taken. Inez, big thanks to my roundtable on this morning. Appreciate it. Coming up, General Motors CFO following earnings for the second quarter. That's next on Opening Bid. General Motors is out with better than expected earnings for the second quarter and another upwardly revised outlook. But with fresh Trump tariffs swirling and memory chip inflation staying a headwind, can GM keep the good times rolling? Yours truly and Yahoo Finance senior autos reporter Pras Subramanian caught up with GM CFO Paul Jacobson.
It is a great day, great results again. I think the theme today is consistency. As we've talked about for a few years now, our go-to-market strategy, our inventory discipline, our incentive discipline, we've now been below the industry average for 3 years. You look at the improvement that we're seeing in warranty, consistency in the consumer, improvement in EV profitability. We've really got a lot of momentum behind us, and this quarter is yet another example, delivering inside the 8 to 10% margin range in North America that we targeted a couple of years ago, and we've been able to get back to even in the tariff environment. So I would say that things are going really, really well, and we expect more in the future.
Hey, Paul, Pras here. So I noticed that you mentioned transaction price $52,000. Kept inventory levels pretty tight, 50 to 60 days, where you want to be exactly. But what does it sort of indicate in terms of, is there a constraint there with affordability? Are Americans still sort of, will it pinch there? Can you still sort of maintain pricing power in this environment?
Well, I think if you look at where pricing has been, it's been pretty consistent this year, which is what our expectations were going into the year, maybe slightly ahead of it. We haven't taken a lot of price. We just kind of been annualizing what we did for model year 2026. So the consumer's been pretty resilient over that time period, and our truck sales are up about 4% year to date. We expect it to be flat for the year, but that's more to do with production and cutting over to the new truck platform that we have coming out at the end of this year and into 2027. So I would say that the portfolio has performed really well. The customer is resilient. We've seen that in demand, and candidly, we're selling our vehicles just as fast as we can make them.
Paul, you have a really important fourth quarter shaping up with the new trucks rolling out, like you just mentioned. What will be the average prices on some of these trucks compared to the current model year? And what are some of the key attributes in these trucks to get consumers through the door?
Well, it'll be our most capable truck we've ever built, with the new Gen 6 V8 motors, as well as diesel options going forward. They'll have more digital capabilities across the board. So we're really responding to where customers are. We haven't talked about any pricing information yet. We're going to continue to watch the market, see where that will take it. But we're really pleased with the cycle of this last generation of trucks. I mean, late in the cycle, we've got a 42% market share in pickup trucks, which is more than 10 points above our closest competitor. And that usually doesn't happen. Pricing has been consistent, even though we're in the last year of the run. So as we go into 2027, we think we've got some good momentum behind us and a chance to keep our overall profitability and margin improvement going into 27 and beyond.
Hey, Paul, so I want to talk EVs just real quick. I know you guys mentioned a $4.5 billion charge there in the quarter, but those charges are slowing down a bit as you progress through the year. But I want to talk about the EV business. Do you think that we've hit the nadir there with regards to the EV winter? Are you guys seeing a little bit of sort of return beyond past the loss of the tax credit?
Yeah, so I would say EV demand is about in line with where we thought it was going to be after the cessation of the consumer tax credits, which ended last September. We've seen EV adoption go to about that 5 to 7% range, which is generally where it was before the IRA was passed years ago. So I think it's been consistent. What we've had to do here over the last several months is really kind of hit the reset button, because we were tooled up to produce more than 1 million EVs a year. It's going to be a while before the market is there for that. But I think with that stability in the market, it's allowing us to continue to drive improvements in EV profitability, where we're not where we need to be yet, but we are making progress, and we expect to continue to be able to do that over the next few years.
Paul, I'm sure you saw the latest on the tariff headline front. It's our understanding that autos are exempt, but zoom out. How disruptive is it to a business like GM to have these headlines making headlines again? Of course, as investors know, you have a sizable presence in Canada.
Yeah, so the new tariffs announced don't apply to Section 232, which is what covers autos. But we're optimistic and hopeful that all the sides can come together across Mexico and Canada to make sure that trading bloc remains strong to be able to compete around the world. So I think the talks with Mexico have gone well. Canada has been a little bit slower, and we would encourage the sides to come together for the betterment of the industry and just general relations between the two countries. But I think the auto industry is important to the United States. It's important to Canada. It's important to Mexico, and we feel good about the way we've been able to manage through it.
Will this situation cause prices to go up for automobiles like they arguably did on the last round of tariffs?
Well, we never passed through any tariff-related price increases. We said we were just going to be consistent with the way we've gone to market, and we've done that. And I think that's important. We're looking to solve from a productivity perspective, from the warranty, EV profitability improvement, all of these levers that we have that we've announced at the beginning of the year, are providing benefits for us into 26, and we think it's going to continue into 27 and beyond. So, I think we just keep our heads down and want to keep executing against the backdrop.
Hey, Paul, is there any risk of, I know you guys are sort of relying upon some IEEPA refunds there from the tariff point of view. Is there any risk there of that not materializing or being delayed, and how does that affect your guidance going forward?
So we took an accounting credit in the first quarter for the IEEPA refund. It was about $500 million. We haven't updated our cash flow forecast for that. In fact, the guide today is really, the guide up today is really more of a function of what we've done in the first half of the year and allowing that to continue into our guidance range. But, we're optimistic that we'll get that. I think it's just a matter of time. We're following through the processes and procedures to get that back to us. But, we want to work proactively with the government on it as well.
In light of what we're seeing on the tariff front, Paul, do you have to accelerate the onshoring investments you're making in this country? How much do you plan to spend this year, and where is that capital being allocated?
Well, we announced last year about $6 billion in total investment across, bringing the truck production into Orion, Michigan, as well as, bringing new Gen 6 engine capacity into the U.S. as well. So, I think we're going as fast as we can. We should start production next year, early next year. From that, we're ramping up some of the cost side of it today. That's why you'll see a little bit of pressure in the back half compared to the first half. But as we get production ramped up into 2027, we think this is going to be really good for the company and going to represent a tailwind for us into the future. We'll have almost 2 million or over 2 million vehicles produced here in the United States when all this work is done, and we feel good about all those decisions. Lastly,
Paul, there were some reports recently that GM is using co-robots on its assembly line. How do you see these robots helping to make vehicles longer term, and how do you address the criticism from unions who are saying these robots are now going to take the jobs of human beings?
Well, when we use the term cobots, it's about making our workers' jobs safer, more efficient, more consistent across the board. And we partner with the shop floor to make sure that we're targeting those areas that have the best impact. So we feel good about our efforts and all of the people that are contributing to the success of GM.
Before you go, I wanted to share a stat of the day, fresh off Yahoo Finance Alpha Space. I thought this one was interesting as I did some analysis on Meta into earnings next week. An undemanding valuation for Meta may be enticing the bulls into believing the worst has been priced into the stock when it comes to AI CapEx spending unknowns. Meta shares are trading on a forward PE multiple of 20.75 times, below the 7-year average of 22 times per Yahoo Finance Alpha Space data. I have the full story on what else is driving the stock now on the Yahoo Finance homepage and on the meta analysis section on AlphaSpace. Julie Hyman has you next. Market Catalyst.
Welcome to Market Catalyst. I'm Julie Hyman. 30 minutes into the U.S. trading day, let's take a look at the major averages. We are seeing a bit of a rally happening here today. As we've seen in recent days, once again, divergence between the Dow and the Nasdaq. Today, the Dow is up about 183 points, about 1/3%. The S&P is up 0.5%, and the Nasdaq is up 0.9%. And again, this has been a pretty consistent pattern here over the past couple of weeks at least, where we have seen the Nasdaq magnifying the returns of the Dow both to the upside and the downside, but definitely a split in between them. If you look at what is working on the sector level today, it's tech that is pretty much single-handedly causing the rally in the S&P 500. The XLK, which is that tech sector ETF, is up 2%. Everything else is underperforming the S&P 500, and consumer staples and communication services are down the most. Now, within tech, it is largely semis that are driving a lot of the rally today. We had a report that TSM, Taiwan Semiconductor, was going to be raising prices by 10%. Those shares are up 3.5%. NVIDIA up modestly, along with Broadcom. And then many of the memory chip makers that had been sort of battered during that pullback in the stocks are coming back a little bit today. Micron is one example of that. And we're seeing some of the other chip makers rise as well. And then if you broaden it out and look at other areas of big tech, Alphabet down about 0.7% going into its earnings report. I noticed SpaceX bouncing back a little bit today, up by about 5%, but still well below its IPO price. It's at $126.11 right now. $135, of course, was that price. So we have like what has been something of a rotation. To go back to sectors for a minute and look at year to date, energy still the best performing group, followed by technology and industrials. So there's been a little bit more rotation happening under the surface recently, but tech has still held pretty steady on the year as one of the best performers in energy, as the longer term trend in those oil prices has been higher. Let's talk more about where investors should sit here going into this big tech earnings bonanza that we're going to be getting into in the next few days. Julian Emanuel's with us, Evercore Senior Managing Director for Equity Derivatives and Quantitative Strategy Team. It's good to see you, Julian, today.
See you.
So, do you think, I feel like every quarter we're like, oh, it's the make or break quarter for big tech, but how are you thinking about how the earnings from big tech are going to inform the trade? Because sometimes we've had a little bit of a divorce, even if it's temporary, between the fundamentals and how the stocks are trading.
Well, it's not just the divorce between the fundamentals and how the stocks are trading. It's centered around the psychology around the AI spend. Is the dollars going to get the ROAI that the expectations have been for a number of quarters forecasting? And then furthermore, what you've had is this incredible divergence really over the last couple months between the day-to-day performance of the semiconductors and the Mag 7 themselves. We actually think that this earnings season is likely to sort of square the circle, if it will, in that you're going to see great earnings come out of the Mag 7 and the hyperscalers. You're likely to see that the narrative around the CapEx spend remains strong. We think we're on track for $1.1 trillion in hyperscaler CapEx in 2027, with potential upside to that number. And we think, different from the last couple months, you could get a situation where both the semiconductor names and the Mag 7 rise simultaneously on the back of good earnings reports.
Julian, I've been interested in reading through some of the earnings calls from some of the non-tech companies that have reported thus far, and trying to get more clarity on AI and what it's flowing to, right? Is it helping companies increase efficiencies, and is that way is sort of like other run-of-the-mill productivity enhancers we've seen over the past few decades? Is it boosting revenue at some companies? It seems like the cost side is starting to happen a little bit, but for non-tech companies, the revenue side isn't necessarily happening yet. I'm curious what you're zeroing in on and what you're trying to learn from some of these earnings also.
That's a pretty fair assessment, although I would say you see a lot of consumer names sort of underneath the surface, better able to manage their inventories, which is actually driving volume. So it's almost second derivative in terms of the revenue line. But really, when you think about it from a productivity perspective, you're still in what we would call the discovery phase of the AI revolution. And frankly, what we've seen is sort of a pause in the productivity bump in over the last couple of quarters, and we think might pause again towards the second half of the year as the post-pandemic rationalization in terms of margins, in terms of workplace efficiencies, is waiting for the handoff, which we expect from AI to drive productivity, which we estimate could be as high as 2.4% next year.
Wow. So you think the handoff is imminent, or at least, we don't have to wait too long for that to come?
So, and again, there's also this issue of how you shape the narrative. And you know full well, Julie, particularly in an election year, you have to be sensitive how you're talking about, labor force deployment, how you're talking about substitutability, and all these other elements. But underneath the surface, we're seeing it, and we're seeing it actually more in places that you might not have expected it. Small cap healthcare, for example, whose share prices have been extremely strong over the last year. Anecdotal evidence of it driving efficiencies in companies like that. And again, as I said, the larger companies, I think you'll see a greater willingness to share exactly how you're driving both the cost save and the revenue line, let's say after the midterm elections.
Yeah, interesting. You've written a lot about the brave new world of increasing tech stock volatility. And boy, we are in it, right? That even if your bull case is intact, like the queasiness of the sort of day in, day out volatility, it's been juiced in part by the single stock options and zero dated options too. How do you think about that? How do you advise investors who are looking at the markets every day and seeing this kind of volatility?
Well, the good thing is if you've invested for more than a couple years, which, I think many of us are in that group, you've already seen the kind of volatility that you had to live through. And I think one, particularly when you think about the investing public, the fact that the investing public was canny enough to be buyers the entire way down during the tariff tantrum shows you that there is an understanding of how to manage the volatility. And frankly, look, we always say this, as the economy remains strong and as the jobs market remains solid, people don't feel pressured to have to reduce their shareholdings so they can operate in a convex manner. The market sells off, you add a little bit more. The market, pushes to new highs, you retain perspective and you stay disciplined. But it really is in an environment like this, with so much noise, both geopolitically and in terms of tech stock valuations and tech stock volatility being this high, emotional control is very, very important.
Yes, and the noise ain't going anywhere, right? Like, as you mentioned, it's an election year, it's a midterm year. So as we get closer to the midterms, is volatility going to increase? And what else would you be watching and sort of be wary of as we get closer?
Well, so again, in terms of technology in particular, AI has already become a lightning rod politically. You're talking about issues like data center regulation and halts on development and so on. And of course, with the predominance of both the left and the right trying to address the needs of working people, there will be more sensitivity around AI and the employment narrative. But for our point of view, you're likely to get volatility regardless, A, because we're near highs, B, because the oil prices started creeping up again, unfortunately, and C, because September, when we have to return from the beach and our vacations, the market's always more volatile.
Yeah, for sure. So, okay, so the clients who are coming to you, as you wrote recently, and want some protection from all this volatility, you guys have a sort of negative beta basket. So tell us about that basket and who it's designed for and what kind of allocation you think folks should be putting there as they're worried.
So it's really designed for everyone. Basically, it started with this realization that in an AI-driven world, there are very few assets that actually provide protection or diversification from the AI trade. It used to be emerging markets, but the domination of Korea has sort of, made the emerging markets really supercharged versus AI here. And so what we noticed was actually on a day in and day out basis, a larger cross section of the S&P 500 was trading inversely to the index itself than we had seen at any time, with the exception of 2001. And frankly, that gives the investor who might be uncomfortable holding a larger cash position, who might not want to hold index options, a chance to own stocks very value-oriented, which is unsurprising given that growth is really the technology tilt. Energy, we understand. Consumer staples, defensive, but utilities, which have actually acted as offense for a lot of this cycle, and insurance stocks of all the sort of odd places, nevertheless, have been correlating inversely. And when you think about it, putting a slug of your portfolio in a strategy like that, whether it's 5% or 10%, whatever you think, really does make a lot of sense and helps you sleep better at night. And going back to what I said earlier, that kind of diversification gives you a greater ability to be a buyer of the dips rather than trying to hunt for protection when it's too expensive.
Listen, we're all looking for something that can help us sleep better at night, so I'm all for it. Julian, great to see you. Thank you so much.
Thank you.
Coming up, 3M's turnaround strategy is starting to pay off. At least that's what maybe those earnings numbers that just came out this morning are indicating. We're going to dive in next. 3M shares are climbing after it raised its full-year outlook. The company's turnaround strategy is starting to gain steam as it focuses on simplifying operations and making new products. Let's take a look at the industrials heat map on AlphaSpace. First, I'm going to look at 3M versus the XLI, which is the broader sector of industrials. And we've seen 3M has actually underperformed this year. It's up, call it 8% or so, but the industrials more broadly are up something like 13%. So we have seen that underperformance thus far. If you look at, if I can scroll down and look at the heat map here, for today for the industrials, 3M stands out with that 10% gain here amongst what is a mixed market otherwise within the industrials. SpaceX stands out. I guess we can consider it an industrial, sort of aerospace and defense. As I mentioned earlier in the show, it is bouncing back today too. And some others that stand out today, BE Aerosystems, we've got FedEx that is on the rise today as well, but otherwise kind of a mixed market here as 3M reports its numbers. Let's talk more about 3M now. And joining me is Jonathan Secreta, CFRA research analyst. Now, as I said, Jonathan, 3M has been trying to sort of turn itself around, right? It's been trying to simplify operations. At the same time, it's been trying to boost innovation. What did this quarter tell us about how it's doing?
Exactly. And really, since Bill Brown took the helm as CEO, we've seen that turnaround be largely successful. We currently have a strong buy in the name, target price of 185. And I'd say this quarter is really another point of evidence to show that the turnaround has been successful. We've seen an acceleration in organic revenue growth. That was really a show me story. A large part of the strategy was to reinvigorate growth at the company. It's been very much so a laggard in that regard over the past several years, growing underneath broader economic growth. So this quarter is very encouraging as far as actually seeing that take place. A series of new product introductions, growing alignment to data center CapEx, as well as really a very positive macro industrial environment is helping the company achieve a high rate of growth.
Jonathan, why hasn't that translated into better stock performance yet? Is it just that investors are waiting for more quarters under the company's belt that look like this one?
Yes, I think that show me story is still intact for investors. They're still waiting to see that this is a consistent growth story. That is, I mean, there were fears heading into this quarter that some of the easy gains were made for 3M as far as margins, as far as releasing some new products that were in the pipeline for quite some time. But I think now it's starting to show, in our view, that this is more than just an easy gain kind of cultivation for the CEO. This is a turnaround, we believe. And I mean, it's really helped splitting off from Solventum as far as focusing R&D spend, focusing on really reinvigorating that product pipeline. If we were to nitpick a bit, I'd say the consumer group is still underperforming. It's really struggling with that organic sales growth. And in our opinion, there's still a lot of room for portfolio shakeup there. This really is less of a place for product innovation to take place, in our opinion. So we think there's still plenty of room for 3M to continue to trim down some of its portfolio bloat and really better align to higher growth markets. And like I mentioned, data centers is recently become a growth driver for 3M, recently entering a partnership with Microsoft. So I think this is just the beginning for 3M in this market. Really, the broader industrial sector is trying to figure out how to get a slice of the pie. Our base case is for about $1 trillion in CapEx spend from hyperscalers and beyond this year. So a lot of CapEx there is starting to flow down to the sector. And companies like 3M are trying to get some exposure there.
Yeah, everybody wants a piece, right? As you mentioned, like people who think of 3M as the pandemic mask and Scotch tape company might be surprised to see this data center growing business. What exactly are they doing? Like, where do they fit into the AI infrastructure story?
So their partnership with Microsoft was with connectors. They have over 80 different product divisions. So there's really just a large kind of broad portfolio. I think that what investors might not realize is that over half of the portfolio is aligned to the industrial economy. And there's been some cascading of CapEx from data center spend, right? I think really first and foremost, electrical equipment manufacturers, electric generators have really had to invest to expand their capacity at factories. So that has flowed down to a lot of machinery names in the broader general manufacturing sector that actually support those factory output. So we're starting to see that cascading of CapEx down to maybe those second-tier beneficiaries, which is helping out a company like 3M that has a large portfolio of manufacturing industrial products. So I think that we could expect to see additional M&A activity. We're starting to see 3M, especially as it pushed off Solventum, engage in M&A. I think you could see additional activity there as far as kind of shoring up and expanding that business model towards meeting data center demand. Also, semiconductors. Over the past several years, we've seen a lot of reshoring capital expenditures. Right now, what we're seeing is a shift from the build out of the shell to actually outfitting and equipping those factories. So that is also helping the industrial economy right now, is the shift between shell to actual on-the-ground factory floor equipment, which is also benefiting 3M. So really a confluence of secular drivers here: reshoring, data center spend, reinvigorating the overall industrial economy, which is a majority of 3M's direct sales.
And you mentioned that sort of industrials overall are trying to get a piece of AI. And I guess it sounds like you can't sort of apply a lens on all of them, but I'm curious if you have a couple particular favorites, or how you think the industrials, if you had to grade them, were approaching the challenge overall.
So a company like 3M, they are so diversified that you're not going to get really pure play exposure to the data center CapEx tsunami. There are some names that are much more plugged into the opportunity. It's really hard not to like the electrical equipment space. We think about companies like GE Vernova. As far as power generation is concerned, there's a huge opportunity in that regard. You have bookings going out to the end of the decade for the large turbine engines. You have Caterpillar. I mean, they're the main reason why they've had such an incredible return year to date, leading the overall Dow, is because of their power generation equipment. Those gas reciprocating engines, we've seen huge demand. They're restructuring their business really to cater to those customers. So I'd say more direct exposure is to our liking. Avertiv, Eaton Corporation, there's a very long tail as far as the demand trajectory for those companies. It's going to take years to ship out those backlogs of orders, say for a GE Vernova or even a Caterpillar. So the demand is there, and that's equal pricing power. The margin quality of those companies, especially in electrical equipment, are seeing a very dramatic turn higher. Really, given how strong demand is, they can kind of name their price, so to speak. They're getting deposits up front just for customers to hold place in line. So very, very strong margin in sales performance for that space.
Jonathan, good to see you. Thank you.
Thanks for having me.
And earlier we showed you Yahoo Finance's Alpha Space platform. It is a new professional-grade financial platform featuring advanced charts, real-time news, customizable investment research, and more. And you can access all of those tools by using the QR code on your screen. Coming up, we'll take a look at some of today's trending tickers, and President Trump imposes more tariffs on Canada. We'll explain why and what could happen next. get to some of today's trending tickers. We are watching Utz, Nebius, and Novartis. First up, Utz, the snack maker, potato chip maker, probably most famously, also makes pretzels. The company has agreed to go private in a transaction with the company called Intersnack. $14.25 a share in cash is the takeover deal. You see the shares are up by nearly 90% and are still shy of that level. So obviously this is a significant premium that Intersnack is paying here. The Rice and Lissette family and Intersnack are each going to own 50% of the company. Now, Utz is a company that went public, I believe, through a de-SPAC deal sort of in the last few years, but the shares had been languishing as of late. So now these entities stepping in to the rescue and sending those shares much higher. Moving on to Nebius, one of the neo-cloud companies, NVIDIA reporting in a new filing that it now owns just over 22 million Nebius shares. That is a higher number than, I believe, the 1.19 million shares previously reported. And then they had an agreement having to do with a warrant to purchase more shares or to get more shares. And so it looks like that maybe that part of that was exercised, but part of it can't be exercised until September. Whatever the case is, NVIDIA owns some of Nebius, and we also have our friend Paul Meeks over at Freedom Capital Markets raising his recommendation to buy from hold for the company as well on what he believes are stronger fundamentals behind the data center build out for that company. And finally, Novartis, the giant Swiss drug maker, that company reporting better than expected numbers here. Cancer medicine offsetting some of its blockbusters. Some analysts saying this was the peak of a patent cliff issue for Novartis, which is an issue in most of the large drug makers. At the same time, some analysts pointing to the fact that the company did not raise its forecast on these better second quarter numbers. So I'll be talking to the CEO of Novartis, Vas Narasimhan, about all of this on the company's results. That's coming up at 3 p.m. Eastern on Yahoo Finance. Well, the Trump administration is threatening to impose additional 50% tariffs on some Canadian goods, accusing Canada of discriminating against U.S. exports. Washington correspondent Ben Worshkull joins me now with a closer look at what is affected or what may be affected. Ben, it had been quiet for a little while, although we'd had some, after the 10% blanket tariffs were overruled, we knew we were going to get some specific investigations, right, that were maybe going to result in tariffs. So what process resulted in this, and are these tariffs actually going to go into effect?
Yeah, Julie. So this one, we still don't have a lot of sense of the process behind it. This is a new tariff authority. This is different than the investigations around Trump's global tariffs, and kind of came out of the blue. Trump is using a tariff law from 1930 that's never been used for this before to impose these. And what he's trying to do is he issued 3 proclamations yesterday around the issues of automobiles, alcohol, and dairy products that he's unhappy with how Canada is approaching. Basically, Canada retaliated to Trump's tariffs with actions in these 3 areas, and now Trump is threatening to retaliate to this retaliation. These will encompass a wide array of goods here. I went through some of the filings here, and there's over 25 pages of different goods that will be impacted here by these 50% tariffs. As you mentioned, they don't go into effect for 30 days, so there's questions about whether they go forward. But there's a number of items here. The White House described them as ranging from cement to hockey sticks, so a good amount of goods. There are some major goods that are not going to be impacted here. And the Trump administration was very clear about that up front. Oil is a big one. Heavy crude oil from Canada remains very important for U.S. refineries, and that's exempted from these tariffs. Potash is another major one. This is a manufactured salt that U.S. farmers are really reliant on for fertilizer. So that was immediately ruled off the table here. And we do have some analysis this morning that the overall macroeconomic effects here, in spite of this headline of 50% tariffs, are a little bit more limited than initially realized. Capital Economics has a good analysis this morning that calculates these goods that are going to be under the 50% tariffs, if this goes forward, amount to about 5% of U.S. imports from Canada. That's still $20 billion with goods, shows how big the U.S. relationship with Canada is, but it's still about 5% number.
Yeah. All of that said, there are some reports starting to emerge that President Trump wants to reissue many tariffs or issue new tariffs, that maybe there's a little bit of an internal back and forth, perhaps, in the administration about this. What are you hearing, Ben, and what should we be watching for?
Yeah, I mean, the Trump administration is clearly trying to balance here Trump's really strong desire for tariffs. I think these Canadian tariffs are a good example here. This is kind of coming out of nowhere and is a really high number based on his unhappiness with Canada retaliating to him. As Trump says all the time, 2 countries retaliated to his tariffs over the last 17 months, China and Canada. He's really unhappy about that with Canada. And so he's clearly looking to go forward with tariffs. There is a lot of pushback, both from outside as well as within some voices within the administration, just in terms of the price pressure that's put on. So you're seeing a real tension here. Brazil tariffs were announced last week. There's a lot of exemptions there because even the Trump documents acknowledge there would be a lot of economic consequences for raising prices here. So there's a definite tension here, but we are going to see a lot of tariffs expected to move forward in the weeks ahead. These global tariffs do roll off. Trump has 10% tariffs on the globe now. They run out of authority at the end of this week and are expected to be replaced by a different authority. There's no indication that Trump is willing to just kind of unilaterally back away from his tariffs. These Canada tariffs are clearly shows how he relies on tariffs and threatens them almost every week.
It's really interesting that you mentioned that both Canada and China are the ones that push back. A post on X from Brad Setzer caught my eye. He is a CFR senior fellow, very closely watched voice on international trade issues. And he said the fact that President Trump thinks trade with Canada is so problematic that it warrants 50% tariffs on many Canadian goods, while apparently thinking trade with China is just fine now, he said is a powerful indictment of his second-term trade policy. But it leads me to ask, okay, what about China? Are we going to get, is there going to be more to come there?
Yeah, I think Trump. What's really interesting about this to me as well, to Brad's point there, is that Canada has this really special sort of negative place for Trump at the moment. We've seen that throughout his entire term. More tariffs are expected to come on Canada. What we're expecting is about a 12.5% base rate on China as a result of this. But Canada is clearly part of Trump's focus here. He wants to put 10% baseline duties and then these 50% tariffs on a range of other goods. It's based on this idea that they stood up to him. The contrast between Canada and Mexico is I think, is an instructive one here. Canada and Mexico and the U.S. are all engaged in USMCA negotiations right now. USMCA is the overall trade agreement here. The U.S. Trade Representative is headed to Mexico City this week for talks there, and talks on public are all positive there. Canada's Mark Carney is basically saying, I'll be willing to talk about this. I want to talk about this, but there's all sides acknowledge they aren't even having formal negotiations at this point. So there's just a real kind of personal tension between the U.S. and Canada that we've seen for 17 whole months now.
Yeah. Ben, thank you so much for tracking all of it for us. Appreciate it. Coming up, a retail turnaround story, how Michaels is mounting a comeback. That is next. From craft supplies to party favors, Michaels is betting that products under $10 still have real power with price-sensitive consumers. Yahoo Finance's Josh Lipton spoke to Michaels CEO David Boone.
David, it is good to see you. So I was reading, David, you're all redesigning stores now to feature more items under $10. Maybe start there, David. Like, why is $9.99? Why is that such an important number, David? I mean, is it just psychological, or no, you actually really see that show up directly in your sales data?
Well, we see it directly. First of all, thanks for having me. Directly in all of our sales and movement data. And it's just a price point that matters in certain categories to a lot of customers. In fact, in our business, just north of 60% of the items that we sell are sold for less than $10 across a 25,000 unit typical assortment in a store. And we know when we invest in price, we can attract new customers to the business and help grow our customer base.
And the tricky part, I would imagine, Dave, is your costs aren't frozen, right? So how do you do this but also maintain your margins?
Right. So there's a lot of moving parts in a retail business, as you can appreciate, right? When you sell 25,000 different products, you have services. What we're able to do is find those products that matter the most to customers and attract customers to our store. And then what we hope to do is wow them with great additional products and additional services when they're in store, such as our custom framing, personalization services, great Halloween decor items. So that is the strategy that we're going, is finding out what matters, use that to reward the customer, and then and hopefully sell them some additional products while they're in store.
We do see the same trend with other retailers, David. You know, the Journal has a good news story on this. Others very focused on $9.99 as well. I mean, really everybody from Walmart to Hasbro. I guess what makes you all different here? What's your competitive advantage for $9.99?
Well, I'd say our competitive advantage is certainly beyond just a price point. The way to think of Michaels is, we're going through a transformation right now to reinvent this company. And the $9.99 and the aggressive price points in certain product categories are part of it. Another significant part is in-store events and services. For example, we run birthday parties in all of our stores. And last year, we cut the price of birthday parties in half to make that more affordable to drive customers into our store network. And as you mentioned at the outset of the show, we are investing in our stores. We have built new departments in our stores. We're improving the experience. And so a combination of a better store experience, better customer experience, services and events, and great products at the right price for customers is what's really working well for our customers and for Michaels.
There was this good Bloomberg piece about you all. Of course, you saw it, David, about sort of the reinvention of the Michaels brand. And it quotes you as saying, "We had a reputation as being your grandmother's store." Now that's interesting. What did you mean by that, David? And I guess, have you pivoted to attract, a younger shoppers?
Yeah, what's very interesting about Michaels is we actually have a pretty broad demographic. And when I look at our demographics and our customers by age, from Gen Alpha, Gen Z, all the way through to boomers, all of these demographics are growing really on demand for our products and services. And what's intended by something like that is this is a brand that's beloved by consumers, but needed more attention in the physical store environment, as well as refreshing our product assortment to make it more relevant for today's day and age. And that's quite frankly what we've been doing. And so far it's resonating with customers.
It was also interesting, David, reading through the piece, it was clear you didn't just survive while Party City and Joann went bankrupt. You really went after their customers. You added yarn and sewing machines. It sounds like you bought IP. Was that about just taking market share, David, or no, that was also part of this broader reinvention story?
So our market's been changing, our competitive set's been changing, and we've refashioned our purpose to be the center of creativity and celebration in every community in North America. And so what came under that strategy was the movement into party supplies, balloons, et cetera, obviously facilitated by the exit of a competitor. And the Center of Creativity allowed us to build out these knit and sew shops and acquire the Joann's IP. And so you put all that together, combined with what I talked about around reinventing the core business, that core experience, the merchandise, services, and events, and you have a new business that's very relevant for consumers.
Amazon, of course, David, pretty much sells, everything. I guess I'm curious why you think Michael still needs brick and mortar, physical stores. You just think there's an experience, or maybe there's certain products that people can't enjoy on if it's just online?
I think our customers come to us to be inspired. They like to walk the aisles of our stores. They want to touch product. They want to grab artificial floral products and put them together in a bouquet. They want to touch fabric. They want to imagine possibilities with our products, and that definitely favors an in-store environment. And look, we're seeing traffic in our stores grow, pretty strongly. So obviously, the consumer, that's what they're looking for.
Is the younger generation, David, more interested in crafting? I'm curious if that's a trend, a theme you see.
Yeah, I mean, it's a great trend out there. So you've heard about, there's so many young people getting into knitting. Sewing is growing, something we call guided arts. So think of paint by numbers in a modern sense. Diamond art, like all of these things, jewelry making, all of these things are growing. And so again, we see them different segments growing with different crafts, but there's an interest in participating in hands-on crafts. In fact, our research suggests that 70% of consumers under the age of 30 are looking for ways to put down their phone and reduce screen time, and certainly the products and services that we offer fit into that.
David, finally, we're always interested in line of sight in the consumer. I'm curious how that consumer is holding up broadly as you see it versus 6 months ago or 12 months ago. Healthy, resilient, stretched? How would you characterize it?
All of the above. So I think it's been pleasantly surprising how strong the consumer has been throughout the first half of 2026. I think they're hanging in there. There's definitely stresses out there, and consumer behavior is changing. So for example, when we run a promotion, we see much more responsiveness to that promotion than we would have seen a year ago or 2 years ago. But generally, the consumer continues to spend in discretionary retail.
David, great to have you on the show today. Thanks for your time.
Great. Thanks, Josh.
Coming up, the CEO of Cytokinetics on the state of the biotech sector and future innovation pipeline. That is next. The biotech industry has surged over the past year, the stocks that is, as investors are gaining more confidence with favorable regulation and medical innovation within the sector. One company hoping to ride the wave of optimism is Cytokinetics. It works in muscle biology with special focus toward cardiovascular disease. Robert Blum is the CEO of Cytokinetics, and he is joining me now. Thanks so much for being here.
Thanks for having me.
And you guys are perhaps somewhat unusual. You're not unusual in that many biotech companies work on a drug for a long time. Maybe you're unusual because of the length of time that you worked on it and that you actually got it through when all was said and done. The drug is called Mycorrhiza. Tell people sort of in layman's terms what it does and how you see the opportunity.
Sure. So ours is a quintessential American innovation story. Cytokinetics just celebrated our 28th birthday since inception. And over the course of those many years, we were working in a new area of biology, bringing it to what could be new medicines, discovery, development, and now commercialization. So you're referencing Mycorrhiza. Mycorrhiza is our first commercial product. We were fortunate to get both FDA approval and concurrently European and China approval. So we're now global as a commercial enterprise. Mycorrhiza is a new medicine that inhibits a protein involved in cardiac or heart muscle, and where it can be hyperactive in the case of a condition called obstructive hypertrophic cardiomyopathy. Mycorrhiza relaxes the hyperactive mechanics of the heart and enables a relaxation, a return to normalcy. Patients who have an inherited disease called obstructive hypertrophic cardiomyopathy can have a better functional and better quality of life. So these are patients who, with a medicine like Mycorrhiza, can be enabled to exercise longer, live with less breathlessness, and achieve those things that produce a better activity of daily living.
How many people suffer from this? What's the potential market for you all?
Good question. So in the United States, hundreds of thousands of patients have been diagnosed with symptoms. There's probably even a much higher number in the prevalent population, a similar number in Europe. And now, for the first time, there are medicines available for these patients where for many, many decades, there was only a surgical alternative. So we're very excited to be able to bring an innovation like this to bear on that disease.
And then what's the further potential for not just Mycorrhiza, but other drugs that you all are developing? Because my understanding is you're also seeking further indications for Mycorrhiza, right?
Yeah, so we're very excited. Not only is Mycorrhiza now approved for the obstructive form of hypertrophic cardiomyopathy, or HCM, but recently in the second quarter, we announced clinical trial results from the study of this same potential medicine in the non-obstructive form of the disease. And for the first time in a clinical trial, a drug such as this showed activity in that population, roughly an equivalent sized population. And while we've announced those results by press release, the top line, those results will be presented later in August at the largest cardiology conference, the European Society of Cardiology, which will be held in Germany. So we're very excited to be able to bring those results to bear on the scientific and medical community there. And soon afterwards, we hope to be submitting an application for regulatory approvals, again, around the world.
Let me ask you something that people might wonder about your company and other companies like it. 28th anniversary, you've just come out with your first product ever. How'd you stay in business before you actually had a sellable product? How did you finance the business?
So over the course of these many years, we have invested billions of dollars. In fact, net operating loss up till now, over $3 billion, closer to $4. Much of that capital, if not most of it, has come from non-equity dilutive sources. And the beauty of companies like ours, when they do it right, is they combine values of science is in our soul for the benefit of patients with sophisticated business development and financial engineering. Cytokinetics, I think, has set a high water mark in this area for our industry. through partnerships, through monetization of future royalties, at occasion through investment in equities, private and public. We've been a public company since 2004. But for the most part, we've been able to demonstrate through progress in our science the ability to monetize that through partnerships to be enabling of us to advance a pipeline. And for a company like ours that's very biology-centric, the key ingredients are to do that in a way that is redundant across different programs. To your point and question, our first medicine is Mycorrhiza. Coming in right behind that, we hope to have other applications for that medicine and other programs, other potential medicines that build on the same expertise in science and biology. So we have, while this is an inhibitor of cardiac myosin, a protein involved in the mechanics of heart muscle, we also have an activator of that same protein that we're developing for a form of heart failure. And again and again and again, a portfolio of these muscle biology programs.
Now that you have arrived at this point, would you entertain takeover offers, for example, from other companies? Would you be looking to use some of that financing that you've banked, not just on R&D, but on acquiring other companies?
Absolutely, and yes. So we have been a pioneer and a leader in this area of muscle biology, translating that to new medicines. I don't have to tell you, lots of folks know that in the area of metabolic disease, in the areas of bone health, there are lots of adjacencies and overlaps. As we are foremost a leader in muscle biology, we're looking at adjacent populations. Where might there be applications for which we don't necessarily need to be the originator, but we're in a good position to capitalize on that innovation for the benefit of new medicines. So in the area of weight loss, there's an increasingly important focus to muscle and preservation of muscle strength, power, and endurance. Cytokinetics can be a leader in that space. And in other areas that read on severe cardiovascular diseases, where can we build a vertical, a franchise in cardiac disease, specialty cardiology, and neuromusculars, as that is also anchored and rooted in impaired muscle function.
Robert, we have to leave it there, but thank you so much for coming in. Really appreciate it.
Thank you.
Thank you. That is it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.